What's up, guys? I'm nobody special. And it seems like last week, just because the NASDAQ had one good day, everybody in the financial press was ready to say, you see, the Evergrande story is over. It was a bunch of FUD. It's a nothing burger. Onward to new highs. Not so fast. Evergrande has continued to miss payments. Now we've got another Chinese developer. The Fantasia Group has defaulted on a payment yesterday. This as other developers are starting to show signs of weakness, as their bonds start to trade at a big discount to face value. And we got some scary data came out of the city of Shenzhen yesterday. Seems that no matter how they try to spin it, this Evergrande story is not going to go away. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm nobody special. And the Evergrande story, or as I should say, the Chinese real estate story, is not going to go away anytime soon. As a matter of fact, we need to stop calling it the Evergrande story, because I've been saying for weeks now that this story and this phenomenon is so much bigger than Evergrande, that this is a systemic, fundamental flaw in the market structure of real estate in China. And Evergrande is just the symptom. Evergrande is not the disease. It was just the first big domino to fall. And a lot of the information that came out in the last 24 hours is supporting that. Now, before we get into those numbers, guys, I have to ask you, please, could you remember to smash that big, beautiful like button, subscribe to my channel, don't forget the notification bell. It really helps me out. It helps to keep this channel growing, and I would be forever in your debt. Now, with that, let's shrink my big fat melon of a head and get into the story. China's property sector default woes deepen amid Evergrande disquiet. And the award for understatement of the year goes to Reuters for describing the imminent collapse of the Chinese real estate market worth $52 trillion as disquiet. Mildly put, Reuters. Very mildly put. Yes, there's some disquiet. You may find the $52 trillion collapse of our real estate market somewhat unsettling. Somewhat disquietus. Very mildly put. All right, let's get into this a little bit, shall we? Let's zoom in to make Mrs. Special happy. And growing worries about defaults of Chinese property developers triggered a rout in their shares and bonds on Tuesday, with fresh credit rating downgrades and uncertainty about the fate of cash-strapped Evergrande Group sapping investor sentiment. Once China's top-selling developer, Evergrande is facing, we know about this, the $300 billion in liabilities. This is nothing new. We know about the missed payments, but there's something interesting in this story, and I want to highlight right here. Chinese property bonds and shares came under heavy selling pressure a day after Chinese homebuilder Fantasia Holdings said it had failed to make a $206 million international market debt payment on time. Now, I mentioned last week in one of my stories that there's a couple of things that have been kind of repeating themselves. Number one is the denial is very powerful from these executives and these government officials. They will insist everything is fine. Number two is the backdoor bailouts of having state-run companies come in and buy up these companies, basically government bailouts, but not really government bailouts, having government entities overpay for assets. And the third constant I'm seeing is that offshore debt holders, non-Chinese people who own this debt, are getting screwed. And this is played out right here with Fantasia. Again, international market debt payment was not made, $206 million. The holders, the non-Chinese holders of the debt, get screwed. And I just want to read in a little bit more about the Fantasia story, and this is from Fitch. They have, let's make sure you guys can see. Oh, we got to shrink me a little bit more. Fitch downgrades Fantasia to restricted default after missing debt payment. Zoom in a little bit. Fitch Ratings has downgraded China-based homebuilder Fantasia Holdings Group Company Limited long-term foreign currency issuer default rating to restricted default from CCC-. That is a mouthful, as the company failed to repay its $206 million senior notes due October 4th, 2021. There is no grace period for the bond repayment. That last sentence is important. There is no grace period. Now, a lot of the Evergrande payments that were missed in the previous weeks, those had a 30-day grace period attached. So Evergrande still has not technically defaulted on those debts, even though they're now into that 30-day grace period. They have a few more weeks, But in this case, with the Fantasia payment, there was no grace period on those bonds. So they are in default. Now, it seems Fitch has downgraded them to RD or restricted default, which I had to look that one up. Let's zoom in a little bit here. Restricted default indicate that the issuer, in Fitch Ratings' opinion, has experienced an uncured payment default on a bond, loan, or other material financial obligations, but which has not entered into bankruptcy filings, administration, receivership, liquidation, or other formal winding up procedure, and which has not otherwise ceased operating. All right, so what Fitch is telling you here is that they have defaulted, although they haven't admitted to it yet. They haven't officially declared bankruptcy. They haven't started selling off the pieces of the company, but they've defaulted. All right. And I just point out that this is the second lowest rating that Fitch has for a foreign issuer, default being the only rating lower, which it appears that is just a matter of time for the Fantasia Group. So this is a big deal. Right? They've been saying in the news that there's no contagion risk, that the Evergrande story was contained, because U.S. markets had a couple of good days last week following the sell-off at the end of September. A lot of people really wanted this story to go away. The story's not going away. As I've mentioned in previous videos, Evergrande is just the symptom of a much larger disease. The disease is the inherent flaws in the market structure and the demographics and the result of decades of the one-child policy, really these systemic weaknesses in Chinese society that have caused this unbelievable bubble in the Chinese housing market. And when I say unbelievable bubble, you have to understand this is orders of magnitude larger than even the U.S. housing bubble was in 2008, right? When U.S. home prices reached these astronomical levels in 2008, the houses were only trading like 7 to 10 times the average salary of some of the people that own them. I mean, there was the cases of the ninja loans, no income, no jobs or assets, no offense, economic ninja. But really, even with the bloated home prices in the U.S. in the early 2000s, they never came close to some of these numbers, like 46 times the average salary for the median home price in the city of Shenzhen. So the numbers are really, even by American standards of a housing bubble, you have to understand the Chinese bubble has reached a level that is just mind-boggling. And this is a huge market. This is a $52 trillion market. And you need to understand that even if the average home price in the city of Shenzhen, for example, were to be cut in half, it would still be worth more than 20 years of the average salary. Let's say you make $100,000 a year and you live in Shenzhen. That's still a $2 million average price for a home in Shenzhen. It's still astronomically high. And that's after taking a 50% haircut. And if the Chinese real estate market takes a 50% haircut, well, that would be what? $26 trillion worth of wealth that just evaporates, gone. That's how big this bubble is. And that's why I really don't know, with the magnitude of the money printing that's been going on in the U.S. and the quantitative easing, and now we have higher energy prices adding to inflationary pressures in the U.S. But at the same time, we have this massive deleveraging that's on the horizon in China, and the amount of wealth that is at risk of going up in smoke in China. I don't know which one of these stories is going to win out, which of these opposing forces is going to be more powerful. And that's why I've gone into cash raising mode over here. I'm not looking to make new investments. I still do my dollar cost averaging into cryptocurrency, into precious metals, but I'm not looking to buy more stocks right now. I'm looking to raise cash because I don't know which one of these market forces is going to win out right now, but they're just massive. And these are numbers that are unprecedented. They're so big, there's no historical example to draw from here, so we really don't know how this is going to go. But moving on, I wanted to point out something else that I saw today, and that is this Fantasia Group, and it was in this same article. I'm going to scroll down a little bit here. Bond prices collapsed at a handful of the most indebted firms, with Fantasia bonds crumbling below 30 cents on the dollar, while Fantasia Group and Central China Real Estate also saw price falls. And I want to zero in on this one, Fantasia Group, because I hadn't heard about this one. But a lot of times in these articles, what I've seen is they tend to mention, like fifth or sixth paragraph down, the next domino to fall. Like I remember a couple of weeks ago when I first started covering the Evergrande story, similar mentions of Fantasia and how their bonds were starting to sell at a discount kind of forecasted that, hey, Fantasia may be the next domino to fall. So we're seeing that now here as Fantasia misses a payment. They're talking about this Kasia Group. So I wanted to do a little bit of research on this Kasia Group. I had never heard of them. And I came up with a couple of articles. And this is why you have to be so careful with the information that comes out of China. And you really have to read between the lines, because just a cursory glance of headlines shows some really remarkable, great news for the Kasia Group, right? Look, home sales surge for Kasia Group, dated September 8th. What a rosy, lovely headline. Things must be wonderful at the Kasia Group. Home sales surge. Well, no. You got to look past the headlines. All right, here we go. Kasia Group realized contracted sales of approximately 7.9 billion yuan, or 9.5 billion Hong Kong dollars. I don't know why I guess this is a Hong Kong newspaper. Last month, involving a gross floor area. For the first 8 months, accumulated contracted sales were 81.85 billion yuan, up 49% year on year. Now that's interesting. All right, and there's two things I want to point out here in this article. Again, all of the numbers, the headline is so rosy, home sales surge. And then for the first 8 months, we're up 49% year over year. But you have to wonder, why did they pick for the first 8 months? And if you look, there were 7.9 billion yuan in sales for the month of August, but then 82 billion for the first 8 months. Well, that actually means the sales in the month of August were way down on a month-over-month basis, right? Because if they're at 82 billion for the first 8 months, that means they're averaging over 10 billion a month. Well, now they're 7.9. That means they're down almost 20% month over month. I don't see that anywhere in the headlines here. So you have to read between the numbers here. They paint this rosy picture, up 49% year on year. Well, they're taking credit for all the sales in the first half of the year, and they're diluting their bad numbers using these first half of the year numbers to make their sales look better than they really are, their most recent sales. All right, and their most recent sales are not so good because, again, this article, this home sales surge, this is dated September 8th. Well, let's look at something a little more recent. Kasia 9-month sales rise 33% to 87.5 billion yuan. All right, this is dated today. My goodness, what another magnificent headline. 9-month sales rise 33%. What a great number. Things must be great at Kasia, right? Not so fast. Mainland developer Kasia Group reported contracted sales of approximately 5.7 billion yuan. Well, wait a minute. They were down, remember the last article where they were averaging almost 10 billion a month? Well, now the first line here says they're only doing 5.7 billion in a month. Well, that's almost a 50% month over month drop in 2 months. What happened? And why are they saying, oh my goodness, what a wonderful, look, sales are up 33%. Right there it is, right there in the headline. Things are great at Kasia. No, not so fast. Total contracted sales for the company for the first 9 months rose really nearly 33% year on year to approximately 87.55 billion yuan. All right. So again, what they're saying here in these first 2 paragraphs, things are so great. They rose 33% year on year, right? And again, they're using that sales for the first 9 months rose 33% year on year. Well, remember in the previous articles, sales for the first 8 months, right? Sales for the first 8 months were up 49%. You see how they're masking their month-over-month sales decline? These sales are in free fall, but the headlines that are coming out of the company are making it seem like everything is great. My goodness, business is up. It was booming. But now look at the 3rd paragraph in this most recent article. Here's where reality starts to set in. Meanwhile, Shenzhen saw secondhand property transactions drop 80% year on year to an 11-year low of 1765 in September, which is usually a golden month for property sales. All right. Now, when they say secondhand property transactions, that's sale of existing homes. How did we go from sales are up, booming sales surge, 33% year on year, to Shenzhen saw a secondhand property transactions drop of 80% year on year? 80%. Folks, that That is your boom moment. That's Steve Carell in The Big Short saying boom at that meeting with, it was in the movie, it was Bruce Miller, they called him. It was actually Bill Miller was the name of the guy from that story. 80% year over year. That's your good old-fashioned market bubble bursting, folks. When you see an 80% decline year over year, and how does that information somehow only get mentioned in the third paragraph? No mention in your rosy everything is great headline. Acacia sales 9-month sales rise 33%. Everything is great. And then in the third paragraph, actually sales have dropped 80% year over year. Wow. A lot changed in 3 paragraphs, didn't it? And this is why you just can't trust a lot of this information that comes out of China, and why you really have to dissect these headlines, because they use the great numbers from the first half of the year to dilute these lousy numbers that are coming in the most recent months. And these are only going to get worse. If you're talking an 80% year over year decline in sales, folks, these companies are doomed, because these companies are leveraged up to their eyeballs, and they don't have cash to make debt payments, and now their sales are dropping 80%. These guys are hosed, absolutely hosed. So this is why you can tell there are more dominoes to fall. Now, Acacia Group is not nearly as big as Evergrande, but it is still a medium-sized developer. They're worth, tens of billions of dollars or whatnot, and they are one of many. So again, while a lot of the financial press really just wants this story to go away so they can continue to make their new highs in the NASDAQ, so Cathie Wood can talk about her big innovation stories that are going to revolutionize the world and change our lives, and she can keep investing in these high-flying tech stocks, the reality, folks, is that there is a ticking time bomb in Asia. It's already gone off. I mean, an 80% sales decline in Shenzhen, that's not a ticking time bomb. That is a bomb that has already exploded, and we just haven't heard about it yet. And again, it's much bigger than Evergrande. Evergrande was just the first domino to fall. It looks like Fantasia is the second. It looks like this Acacia Group may be the third. We've talked about these other outfits like Cynic and Sunac that could be at risk, that have either missed payments or seen these sudden, inexplicable drops in their share prices. These are all events that foreshadow debt defaults. And these dominoes are falling faster than I can keep up with, to be honest with you. I mean, I have a list of property developer names here in China that I need to go research. Acacia was just one of them. This list is getting longer by the day. The story's not going away. And again, the property sector in China is a $52 trillion market. Okay, there's $52 trillion worth of real estate value in China. And numbers that big, there's just no way that there is no contagion risk. There's no way this doesn't impact China's banks. There's no way this doesn't affect European and U.S. financial institutions. When you're dealing with this much wealth and this much value that's at risk of going up in smoke, there's no way this issue is just going to be contained to a couple of companies or a couple of developers. So long story short, you have to read past the headlines in these articles that are coming out about the Chinese developers. Don't fall for their diluted statistics, especially things like year to date or first 9 months, first 8 months of the year. All right, they're using good numbers from the first half of the year to mask their lousy numbers from recent months. So you have to dig into the numbers a little bit and look past what they're saying. Remember, these people are fighting for their lives, and they need to convince you that everything is good and well and keep investing in their products in order for them to stay alive. So they will say and do anything to cover up their failures. Keep that in mind when you read these headlines. Folks, that's all I got for you right now. I hope you enjoyed this video. I want to thank you for your time. Don't forget, hit that big, beautiful like button, subscribe to my channel, hit that notification bell. It helps me out. It helps me to keep this channel growing, and I would be forever in your debt. Until next time, live small and dream big.